Hello. The company being analyzed is Anawil Wire and Engineering Limited. This company actually recently IPO'd, I think. So today we're going to analyze the company's financials, what the company actually does, and some of its future growth potential. Okay, potential is very important. So the company has a market cap of 1,107 crores as of 28th August. Current price of one share is 443 rupees and the price to earnings ratio of 30 times. If we take a look at past historical financials, all of these numbers are in lakhs of rupees, okay? So you can see revenue from operations having risen from just 54 crores in fiscal year 24 to 143 crores in fiscal year 2026, almost doubling fiscal year 25's revenue of 78.5 crores. Then EBITDA rising from 22 crores in fiscal year 24 to 61 crores in fiscal year 26, 42% EBITDA margin. And you can see the EBITDA margin has risen, kind of risen. Yeah, 42% EBITDA margin, that is really high. And profit after tax of 36 crores in fiscal year 26, the profit after tax margin has boomed from 8.1% in fiscal year 24 all the way to 25% profit after tax margin for fiscal year 26, which is a really good profit after tax margin. Then net worth, which is, I believe, assets minus liabilities, having reached 89 crores in fiscal year 26. Return on net worth, 40%, really nice. Return on capital employed rising from 13% fiscal year 24, 23% fiscal year 26. So that is pretty good. That is nice. That is really good. Then in terms of cash flow statement, here it's written restated cash flow statement. Here we got all the years and pay attention to net cash flow from operating activities. So, as reported by the company in fiscal year 26, the company's net cash flow from operating activities was how much? 18.43 crores. These are again in lakhs. So, actually, with this kind of very impressive growth rate, the company is growing very fast. They're still having positive operating cash flow, 18 crores fiscal year 26, 9.6 crores fiscal year 25, 8.8 crores in fiscal year 24. So I will say, no, that's pretty impressive. That's while it's growing so fast, the company is having a very good growth rate in its revenues. The operating cash flows are actually positive. So these were the historical financials. Now, what does the company actually do? Here it's written onshore wind turbine tower manufacturing. So onshore, meaning not on the ocean bed or ocean, actually on the land that we live in. It's a wind turbine tower manufacturers. We're not talking about the turbines. We're talking about the wind towers, the actual tower. They're manufacturing the tower component of it. Then company overview. So, Anawil Wire and Engineering Limited is engaged in the manufacturing of onshore windmill towers. They have two operating manufacturing facilities, one in Karnataka, one in Gujarat. Now, this 612 towers is their combined annual capacity, which means 51 towers per month. That is what they can manufacture. Now, remember, 612 towers annual, and in the last 3 years, cumulative they have manufactured 459 towers. So last 3 years, 459 towers cumulatively, and right now 612 towers annual. That is the capacity. Order book 359 crores of order book. With 359 crores order book and 143 crores in revenue. So it's quite a gap. Now received LOI, which is letter of intent, which it's not orders, but it is one of the paths to a potentially strong order. Okay, potentially, that's important. It's letter of intent for 38 towers amounting to 120 crores received in quarter one fiscal year 27 alone. So remember the manufacturing capacity, remember the order book, remember the LOI. Okay. Then geographic revenue concentration. Where is the revenue actually coming from? Fiscal year 26. 93% of revenue came from Gujarat, while 6% came, sorry, Karnataka. 93% came from Karnataka. Mishap. 6% coming from Gujarat. So all of the revenue is currently coming from two states, Karnataka, the big one, the actually big one, and we have Gujarat. Then top five customers. The top customer of the company was responsible for 29% of the business in fiscal year 26. Second, 16%. So the top customer having 29% of the business. Okay, there is customer concentration, which could be bad, which could be good. Okay. Then in terms of order book, we already covered it, 359 crores. Okay, this 359 crores is for 379 towers. The LOI of 120 crores is for 38 towers. So perhaps just maybe you can try to see per tower could be how much, but it may not actually be the same or may not be the most accurate figure, but as you can see, the different description of the products. So one is this kind of product, one is this kind of product, tubular, one is this kind of product. So you can see number of towers are differing, the types of towers are differing. That is why the amounts could be different. But as a simple exercise, perhaps just to get a range of things, we can just see per tower, it is coming out to how much? Simple division. Then capacity utilization. Now, first, we will pay attention to this. Fiscal year capacity utilization was at 48.17%. So there's potential to actually scale up capacity utilization, meaning not just putting in investment for new capacity, just scaling up existing capacity. So there's room for growth there. Then Karnataka is the big one, 35 towers per month. Kutch, that is the Gujarat one, is 16 towers per month. This one confuses me. 2024, they're showing Karnataka, and 2025, they're showing just Gujarat. I'm not sure. Sorry about that. But on fiscal year 26, 1.47 lakh tons per annum. Karnataka, 60,000 tons per annum. Gujarat, only 8% Gujarat and 41% Karnataka capacity utilization. So there's actually a lot of room for scaling up. Then this is the final thing. And remember, all of these slides, as I mentioned before, these are from the company's investor presentation documents. So, go to Screener perhaps or go to their company website, and then, click on the investor presentation and read all you want, if you want, of course. Now, three business models. Company has basically three business models we're looking at. One is pure conversion, second is conversion plus materials, third is integrated supply. And you can see the EBITDA margin is declining. But in all these business models, see, as the EBITDA margin is declining, the total revenue in per business model is increasing. And the company is saying that the EBITDA margin declining, but the revenue in the lower margin business model is so much larger that the overall EBITDA value increases, right? We could just go through this. First is pure conversion. The customer supplies the material, Anawil manufactures. It has an average approx EBITDA margin 44-50%. Why is the margin high? Revenue is mainly conversion income. The billing base remains lower. Okay, the costs are actually not that much because well, customer is actually giving them the material. Second is conversion plus materials. Manufacturing plus in-house tower internals, approximately EBITDA margin 30%, 33 to 37%. Why exactly slightly lower? Because they're manufacturing some of the other internal components for the towers, and there's a cost incurred in that. There's a cost incurred in that. Then integrated supply. They'll procure the material, they'll manufacture the tower, they're also manufacturing the other internal tower components. EBITDA margin is way lower because material cost is included in revenue. Absolute EBITDA and PAT can still rise. So EBITDA, right? EBITDA upon revenue. So EBITDA margin is lowering because in the revenue portion, it's rising, right? Material cost is including in the revenue in this one. So the revenue base is rising, but as you can see, scope is increasing. Integrated supply has a larger scope than just pure conversion. Revenue per tower is increasing because they're handling more of the tower, right? They're getting the material in the integrated supply, they're manufacturing the internals also. And in the profit pool, the absolute number is rising while the margin itself may go down, right? Key interpretation according to the company. Lower margin percentage can still mean higher absolute profits when order scope and billing value increases. This clearly reflects change in revenue mix and not weaker business health. Okay. And the company is saying that the EBITDA per tower drives the true performance. A business health should be measured through EBITDA per tower rather than only EBITDA percentage. Okay. EBITDA per tower improved from approximately 22 lakhs in fiscal year 25 on around 135 towers to approximately 29 lakhs in fiscal year 26 on around 210 towers, indicating better operating. Okay, okay. 29 lakh. Okay. Another number. We got another number. 29 lakhs per tower is the EBITDA they generated. Okay. EBITDA per tower was 29 lakhs that is generated in fiscal year 26. Okay, so we got kind of a base number on which we can perhaps project on perhaps the order book and the future capacity, the capacity utilization. If this 29 lakh maintains, you can see, on a 80% capacity utilization, 90% capacity utilization, what kind of EBITDA can we get? That was Anawil Wire and Engineering Limited. So that is it. I think so recently IPO'd. Let us see how the company actually performs in the future.